The commodity market seems to be trying to take a breath after a protracted dramatic rally. Although oil prices have pulled back from the highest values, they are not in a hurry to leave triple-digit figures. Today, the dynamics of quotes are still dependent on geopolitics. Investors continue to assess the sanctions pressure on Russia and its consequences for the global economy. There is enough data for analysis. Negotiations on a nuclear deal with Iran seem to be delayed. Venezuela has stated that it's ready to supply oil to the United States, and other states also expressed their opposition. In addition, OPEC and the IEA are set to release their monthly oil market reports this week. Asia has announced that it may reintroduce pandemic-related restrictions, which are likely to reduce demand. Thus, there are enough factors affecting the value of oil, but the main one is negotiations between Russia and Ukraine. As the parties state, the search for diplomatic solutions continues. A new round of talks between Russia and Ukraine will be held today. If the meeting bears no fruits, oil prices may jump to $120 per barrel and higher. Otherwise, the quotes may suffer losses. From a technical point of view, Brent crude oil futures have been hovering in correction territory for the third day in a row. The quote continues to move around the level of $110 per barrel. Given its global drivers, the market appears to remain in a speculative mood. Therefore, new price spikes and fresh local highs on the news cannot be ruled out. Alternatively, easing tensions around Ukraine may lead to a significant decline in oil prices. In the foreign exchange market, the situation remains unchanged. In global terms, the Russian currency is still retreating from the level of 153 rubles per dollar. In fact, the ruble continues to swing. Moreover, there are no factors capable of calming its erratic moves yet. This week, the focus of market participants will be on the meeting of the Bank of Russia. The regulator has already taken a number of emergency measures, and a new interest rate hike is unlikely. The economic situation is complicated by the fact that half of the gold and foreign exchange reserves of the Bank of Russia have been frozen due to sanctions, but there is still hope for new measures to regulate the market. The meeting will be held on Friday. Until then, the news will obviously continue to drive the ruble exchange rate. For now, the ruble has little chance of gaining value. On the one hand, talks between Russia and Ukraine continue. On the other hand, the number of sanctions against Russia keeps growing. Against this background, market players should be ready for new fluctuations in the currency pair. Today, the dollar versus ruble pair boasts price swings of 5 to 15%. In normal times, such a trading range might seem insane, but under current conditions, it comes as no surprise. From a technical point of view, the quotes are experiencing a correction from the local high of 153 rubles per dollar, with the level of 110 rubles acting as temporary support. If the price fixes below the 110 mark on the 4-hour chart, the pair will most likely return the 100 level. At the same time, any news negative for the ruble may lead to an upward reversal in the pair. Gold is also in a correction phase. Despite its overbought status, analysts remain bullish on the yellow metal. Political uncertainty and high inflation will obviously force investors to flee to safe haven assets in the near future. Now the actions of regulators are in the focus of market participants. They are hoping to receive some clues about the future of their monetary policy, which will help investors reconsider and redistribute their assets. In the meantime, the metal still has every chance of resuming its bullish run amid growing geopolitical risks. Gold futures are still moving in corrective territory, pulling back by over 5% from the local high. At the same time, the trend remains upward and gold may still hit a new high. If the price consolidates above the level of $2,010 per ounce, the volume of long positions will increase. Otherwise, the market correction will continue. And this was the forecast for the start of the trading week from our analysts. As you see, investors are gradually getting used to market uncertainty and the new realities. Watch our videos and stay up to date with the latest news. Have a great trading day and see you back soon.